Microsoft, one of the greatest businesses in history, dropped significantly. But is this a buy the dip kind of moment, or is it the first domino in a much larger market reset, especially for tech? Today, I'm showing you the unthinkable price where Microsoft actually becomes interesting and why 2% of companies now control 38% of the market value of the S&P 500. All right, so let's start by talking about Microsoft. Listen, when something this big drops, people start throwing around words like crash and buy the dip or biggest opportunity we have. But we don't care about the headlines. We care about the business, the fundamentals of the business. Microsoft, no doubt, is an absolute machine. Recurring revenue from Office, Azure cloud growth, massive profits, great balance sheet. The business prints money, and it's still massively growing, especially for a multi-trillion-dollar business. Their most recent earnings report showed 17% year-over-year growth in revenue, 21% growth in operating income, and 24% earnings per share growth. Guys, for a company of this size to do that, that is beyond impressive. And over the last few years, Microsoft's multiple, which is the PE ratio charged, has expanded significantly. Why? Take your list of picks. Maybe AI excitement, maybe interest rates, possibly optimism around future growth, the overall market, or a combination of all of them. But when sentiment cools, which it will eventually, those premium multiples will compress. That's not a broken company though. And it's so important for you to realize that. It's so important to separate the company from the stock price. If earnings continue to compound at healthy rates, today's price could absolutely look attractive long term. But the worry right now is around AI disruption and whether or not they are overspending. And not just Microsoft, everybody in the market. Now, if growth starts to show signs of slowing, especially in cloud, you better believe that that premium valuation will sink further. Remember, every investment is the present value of all its future cash flows. That is the second principle of our principle-driven investing. And the lower the price you pay, the higher your expected return. And vice versa. The higher price you pay, the lower return. And here's the part that most investors ignore. Even a phenomenal business, even the perfect business, will become a bad investment if you pay the wrong price. You have to remember, a stock being down doesn't make it cheap. It just makes it cheaper than it was before. Is it cheap enough now? So let's try to answer this question. At today's price, are we getting enough return for the risk of buying Microsoft today? That's how investors think, not speculators. We saw this with Adobe and PayPal in the past when they started to fall in stock price. They looked cheap compared to their highs, but our process told us to wait for a margin of safety. Microsoft's no different, but we are going to determine that together in just a few minutes. So guys, Microsoft's back over the $400 mark. Here are some key metrics. Roughly a $3 trillion market cap, and I always go right to enterprise value. This number difference here will tell me essentially the debt here. Right now, they're at about $180 billion. Sounds like a lot. But guess what? In the last year, they made $77 billion in free cash flow. Last 5-year average was $67 billion. So it's actually not a lot compared to how much free cash flow they generate. They've got growing margins. 33% the last 10 years, 36% for the last 5, 39% last year. I love that. That's a sign of a healthy business. Balance sheet's great. Now, their cash flow's eaten up $25 billion a year in dividends. Sounds like a lot, right? It's only a 0.85% dividend yield, which is actually lower than the S&P 500 overall. Why? Their market cap is so big that even paying out $25 billion isn't much at all. Just keep that in mind as you're thinking about these things. All right. Returns on capital, great. 19% average over the last 5 years, 15% last year. And look at this revenue growth. Yeah, they've made $100 billion in acquisitions in the last 5 years. But even with that, that's a lot of revenue growth, 13, 14% a year for the last 10 years. I would have never thought 10 years ago that a company of Microsoft size could grow 13%, 14% a year in revenue. That's a lot. Now, guys, I went through a lot of metrics here. And if you're new, it may feel overwhelming. You're not alone. It was overwhelming for me. It was been overwhelming for Warren Buffett and Charlie Munger and every great investor at some point. But you got to start somewhere. Luckily, I teach on YouTube to make investing simple because I was so sick of people trying to sound so complicated and smart all the time. So let's look at the 8 pillars. Guys, we love this. Why? It's the valuation metrics that are high, that have an X. But remember, guys, I want to remind people, just because there's an X here anywhere doesn't mean it's a bad thing. This could very well be a check mark. If Microsoft were to grow 30% a year for the next 20 years, I would absolutely pay today's price without a doubt, beyond without a doubt. So it's all about understanding what the future holds for this company. 2 companies that sell for the exact same metrics. If one can grow 20% a year and one can grow 2% a year, you must pay more for the 20% growth. That's what Buffett and Munger mean. And they say, when you're buying a great business, it might feel like you're overpaying, but you're actually not. So what do analysts think about Microsoft? Well, look at this. They expect profit to double almost in the next 4 years. That's a lot of growth for a company that big. And then in terms of revenue, 17.5, 15.5, 16.5, 17, 14.5. They think this thing is going to keep on trucking. And it very well could. But remember, we're here to teach about margin of safety. Now, we have a story. We have numbers. We got to put it together. And I always tell people, start out your research by putting some numbers in a stock analyzer. Sit there and think about the story. Think about the numbers. What does the future hold? Because at the end of the day, Microsoft's selling for $400 a share. If the stock analyzer tool comes out and says it's worth $1 per share, are you gonna do any more research? No, you drop the company. You don't even think about it. But if it comes out and says, hey, this thing is worth $450 or $500, time to do some research. Or even close, even if it's 400, tighten that pencil a little bit, see where you're at, do more research on the company. So let's pull up the last time I did Microsoft in our software. Here are the assumptions I made on Microsoft. Revenue growth. 7, 9, 11% for the next 10 years. Okay, not unreasonable, not insanely high, not insanely low. I'm probably being more conservative based on what analysts think. But I remember, we haven't had a recession in a while. AI is a very big question over AI. Are they spending too much, et cetera? Profit margin and free cash flow margin. I'm putting the same numbers in here, 34, 37, and 40. PE. What's the PE and price of free cash flow this company should have 10 years from now? Well, guys, this is a premium business. The market average is 15 to 16. So you got to go higher for a good business. How much higher? That's the art of investing. I put in 20, 23, and 26. You might think that's too high. You might think that's too low. That's the point of having the software. So you can put this into there. And finally, 9% desired return, no margin of safety, intrinsic value. What is this thing worth on the market? But remember, you need to buy companies with margin of safety. So I hit the analyze button. The stock's currently at $400 a share. I have a low price of $345, high price of $672, middle price of $485. Guys, to me, it's interesting. Now, guys, I'm going to throw a little curveball in here. Let's assume that in the next 10 years, they do 11, 13, and 15% revenue growth. That's all I'm changing out of all my assumptions. This is why investing is difficult. Looks like a screaming deal now. Low price of $470, high price of $920, middle price of $660. This is what makes investing difficult. For me, making that big assumption on such a big company with this AI outlook, kind of like, I don't know. If somebody said to me, Paul, these assumptions here are correct, I wouldn't blame you. Like, it's not like you're assuming 20% growth. You're doing what they did in the last 10 years with a lot more runway in AI. This is what makes investing difficult. There's no right or wrong answer. And guess what? I look at this going 15% potential return based on 13% revenue growth, which they did for the last 10 years. Maybe it works out. For me personally, I want a little more margin of safety than that. Now, Microsoft might look like it's getting close to becoming a massive opportunity, but that's just one company that's fallen this year. This is not just about Microsoft, because when a company that large moves, it doesn't just affect shareholders. It affects the entire market because it's one of the biggest weighted companies in the S&P 500. When it rallies, the index looks strong, but when it falls, the market suddenly feels weak. And that brings us to a much bigger issue that most investors are ignoring. Just how concentrated this market really is, and what happens when money starts rotating out of these mega cap giants. So let's start with something most investors never realize. The S&P 500 is supposed to represent the 500 largest companies in the United States of America. Sounds diversified, right? But today, the top 5 stocks make up an enormous percentage of the entire index. How much? Guys, remember 5 stocks out of 500 is 1%, but they make up 25% of the value. The top 10%, even more, 38% of the value. Well over 1/3 of the index is represented by just 2% of the companies in it. We're talking levels of concentration that historically only show up during periods of extreme optimism and preceding periods of poor performance. We saw this very similarly in the 1990s, in the late 60s, at peaks of the secular bull market. This is a group of narrow leadership, a handful of giants that are driving all the returns, and everyone believing that these companies could only go up. When only a few stocks are doing the heavy lifting, the index can look and feel healthy, even if most stocks underneath it are struggling. That is not broad economic strength. That's concentration risk hiding in absolute plain sight. Now, in a second, I'm going to share with you something even more interesting. But if you want to get better at valuing a stock and using the stock analyzer the right way, we have a class starting soon. We truly believe that in 8 focused sessions, we can help shape you into a principle-driven investor for life, someone who understands what they own and why they own it. Now, I'm going to let Sam tell you about the upcoming class where you have the opportunity to work with me and my lead analyst, Dalton.
This is, in my opinion, one of the best values throughout all of what Everything Money offers. So imagine that you're going to take a college course, right? You're going to pay, what, $4,000 or $5,000 to go sit there and learn from a professor, probably been a lifelong professor. Maybe he's practiced what he's teaching, maybe he hasn't. In this, you get 8 weeks of classes with Paul and Dalton. It'll be on Zoom. We limit the class size so that you can actually have direct FaceTime with them. I just listened to the options class, the first one that Paul did. The first thing I asked everybody is, I want to get to know you guys. Like, where are you from? What's your history with options and investing? How long you've been with Everything Money? So you're going to actually get to know Paul and Dalton. You're going to get to ask them real questions as you learn. You're going to learn how to read financial statements, look at the 8 pillars, the key metrics, how to understand analyst estimates and actually work to build them into your assumptions and figure out the due diligence you need to do. You're going to learn over the course of multiple sessions how to make good assumptions on Stock Analyzer from Paul and Dalton. You're going to talk about your own personal scenarios and portfolios. You're going to talk about your plan for retirement. It's an incredible course. You're going to learn a ton from them. You're going to actually get to, really know them and be in this scenario where you're on a Zoom with them. You can see them face to face. If they're going through the balance sheet and, you have a question for Dalton about how he assesses something, you just stop and ask him and you actually get to learn directly. The reason this course is an incredible value, because we're all about price versus value, is it's only $497 for that entire 8-week course, 8 classes. And you get 3 months of the software included, which is basically $120 plus off of your price. So guys, if you're interested, I'm showing you the page right now. It has all of the breakdowns and everything. You can go sign up. You can do it right now. You can just click the link, reserve your spot. Like I said, we limit them. I've had probably 15 calls with people and nearly all of them have signed up just in a recent week and a half. So this class fills up. It filled up fast the last time that we did it. It was an excellent class. If you're interested and want to sign up, go click now, go reserve your spot. If you want to talk to me more, we're going to drop a link in the description for a quick 15-minute call where you and I can talk about your goals, what you're looking for, and make sure the class is right for you.
Now, here's where it gets even more interesting. If you compare the traditional market cap weighted S&P 500 to the equal weighted version, that means every company in there is exactly the same. If you have 500 companies, every company gets 0.2%. You're going to notice a huge gap. The market cap weighted index looks fantastic when mega caps rally, but the equal weight version, not nearly as impressive. What we want to see is how many stocks are actually participating in a rally. When fewer stocks are driving all the gains, the foundation is weaker. But the headlines don't tell you that. They say markets at new time highs. They don't say 7 stocks carry the entire index for the last 18 months. And if you're just buying the index blindly, you may think you're riding a broad bull market, when in reality, you're heavily dependent on a few expensive companies. Now, that doesn't mean that I think people should stop dollar cost averaging. I still do it. But it means you have to understand where we stand in this process. Now, here's a little secret. Money leaves clues. When investors pour capital into large cap growth ETFs and mega cap tech, prices rise and multiples expand. That's what we've seen over the past several years. But recently, we've started to see something a little more subtle. In certain areas, inflows into equal weighted funds, small cap ETFs, and mid cap funds have started to pick up. At the same time, the flow of funds into mega cap stocks have cooled relative to their earlier surge. We've also seen ETFs for emerging markets doing extremely well versus the S&P. And there was a notion a few years back that taking your money outside of US markets was insane. And now people are waking up to the fact that value can be found elsewhere. Rotations start very quietly, with capital slowly seeking better risk-reward opportunities. When valuations stretch in one area, money eventually looks elsewhere. It's just logical investment allocation. If I had a fund that had great investments and markets and stocks skyrocketed and all of a sudden got new money in, I'm not gonna go buy those same overpriced stocks. I gotta go look for new ones. So I'm gonna find undervalued markets or stocks. That's part of that rotation. So what happens if this rotation continues? First, continued multiple compression becomes a real risk for mega cap stocks. Again, that means instead of selling for 45 times earnings, they might sell for 30 or 25 or 35. The fastest way to have that happen, there's two ways in which that can happen. Either their fundamentals just skyrocket, their profit goes up 30, 40, 50% very quickly, or stock price falls. Which one's easier? Now, multiple compression doesn't mean a business is bad. Even less profit doesn't mean a business is bad. It just means expectations were probably too high. So when a stock trades at significant premium multiple, even good or great earnings can disappoint. Second, there are neglected sectors. Industrials, small caps, even some staples. They could see renewed interest as this happens. So if earnings growth is steady and valuations are lower, future returns could actually be more attractive there. And here's the part passive investors need to hear. If you're invested in a market cap weighted index, you're more concentrated than you think. Rotation isn't scary. It's normal. Leadership changes, capital shifts, valuations revert. The key is to understanding where the risk is and where the opportunity might quietly be building. So let's connect all these dots together. If the market is heavily concentrated, which we think it is, if a handful of stocks are trading at premium multiples, which they are, and if a capital is starting to slowly rotate, which it seems like it is, then we have to ask a bigger question. What does this mean for the next 10 years? High valuations by themselves aren't the only risk, probably the biggest one. But another real risk is when you combine the two. Expensive markets driven by narrow leadership. Guys, that's when future returns can really end up being dismal. And that's how you set the stage for something investors hate talking about, a lost decade. But I don't look at a lost decade as a bad thing. That might confuse you. Let me get to that. So first off, what is a lost decade? A lost decade is exactly what it sounds like. A 10-year period where stocks go nowhere. Guys, look at 2000 to 2012 or 13. The S&P 500 was essentially flat during that time. After inflation, you got negative growth. Not just that, but a lot of individual companies were down over that period because the starting valuation in 2000 was so high. Guys, even my Microsoft example. In 2000, Microsoft was the company. In 2012, when I started buying it at 8 or 9 times earnings, a tech CEO told me I didn't get it. It was a dying company, and its revenue and profit were growing 7 to 12% a year. How is that a dying business? We had Cisco and Intel. They were the prime example. But even companies like Walmart and Home Depot, which were outside of tech, took over a decade to recover. Now, guys, I love talking about Cisco because this is a company where from here until recently, it didn't hit an all-time high. But yet from here to here, profit was up 10x. Even from here to here, profit was up 5x. If I told you at this point here that profit in Cisco 25 years later would be up 5x, you'd be like, oh, the stock's gonna be through the roof. But it wasn't. Why? Because this was too damn expensive. Remember that guy? Because the rent was too damn high. Because the valuation was too damn high. That's it. And it was too damn high here, but the market still had more to go. Too damn high here, still had more to go. We don't know when the roosters will come home to roost, but eventually it does. Think about that. You took 25 years in Cisco to see your money come back, even though the fundamentals of the business were 5 times better. You took 12 years in the S&P to see the stock price the exact same. Guys, that didn't happen because America stopped innovating. It happened because valuations started too high. When the bubble finally bursts, everyone looks for reasons to blame. But guys, that's just the spark in the room filled with gasoline. We know there's a fire in the corner. There are sparks flying. One of those sparks will cause an explosion. We just don't know which one. That is a great analogy by John Hussman. So, where are we now? valuations by historical standards are extremely high, in some regard, probably the worst of history. And here's the key. If you start at above average valuations, the math every single time shows forward returns over the next 10 years will be well below long-term averages. That doesn't mean a crash tomorrow. It doesn't mean a crash on Monday. It just means that in all likelihood, there'll be some big event or some all of a sudden crash that happens and you have sideways movement for a long time. Let's start with this. The Shiller PE, the 10-year cyclically adjusted PE ratio. What does that do? It takes the last 10 years of earnings. It brings it to today using inflation, so it brings it to today's dollars and divides the price by that earnings number. It's meant to even out the ups and downs of the recessions. Guys, historical average is 17. The all-time high was 1999 at 44. And guess where we are right now? We are currently at 40.2. And let's not stop at that. What about the Buffett indicator? This is Warren Buffett's favorite metric, saying at any given moment, this is the most reliable metric on where the market stands. It takes the total value of the stock market divided by the US GDP because it makes sense. As GDP grows, so should the US stock market. The past few years, the highest it ever hit was about 45% overvalued back in 1999. Where is it right now? 124% overvalued. That's crazy. Now, let's think through this together before you even allow me to jump to conclusions. We know multiples are at all-time highs, historical highs in many, many regards. Valuations feel very stretched. So the way I see it is there's three ways it can go. Price goes down, earnings skyrocket, or a combination of the three. My guess is it's going to be the third one. The easiest way for things to happen is prices fall massively. Guys, during the 12 years that the market went nowhere from 2000 to 2012, what happened to GDP? Well, let me show you. Back in 2000, GDP, in March of 2000, GDP was exactly 10 trillion. By the end of 2012, it was 16.4 trillion, 64% higher, but the market went nowhere. Why? Valuations. So what happened to PE in that time? We went from overvalued to undervalued. That's what's key here. They were 10% undervalued because fundamentals got better. Guys, it takes a long time for fundamentals to get better. It doesn't take a long time for prices to fall. That's what's scary. But that's okay. Now, none of what I'm saying here is predictions. They're just logical outcomes based on starting valuations. What's interesting is in scenarios 1 and 3, I would argue you'll end up in a similar spot in a decade. But scenario 1 creates more opportunity to buy great businesses at great prices. As prices fall drastically, if you're disciplined, that's what I want to do. I want you to be able to say, the fundamentals will get better, price falls big, I want to be on that boat. Now, this is where it gets a little personal. What does this mean for you? Well, I don't know your situation. If you're 25 and dollar cost averaging, this is all your friend. Even though you say, well, Paul, if stocks fall a lot, you got time, you got 40 more years to go. A big correction is your friend. I promise you that. Because guess what? Don't you wish from 2000 until 2012, you just kept buying and buying? It was 40% undervalued in 2009 and just kept buying and watched the surge happen. That's what you wanted. But if you're 65 and about to retire, this might be a little scary. I don't blame you for thinking that way. You're really hoping that we see very limited volatility and more of a little bit of growth over time that's consistent. You don't want those up and downs. Guys, a lost decade is not a prediction. It's the math of paying too much. If you're 65, you can't afford a lost decade. If you're 25, you should hope and pray for one, as you can buy at 2010 prices well into your 30s and get yourself ready for retirement 20, 30 years later. And guess what? If you're purely passive in a market cap weighted index like S&P 500, concentration risk combined with high starting valuations could mean underwhelming returns in the short run. But this isn't about trying to cause you any fear. It's about hoping to help you with your preparation, to be ready for what's going to happen. Because investing isn't about guessing the next year. It's about understanding and hoping for the next 10 years to look out a certain way. So guys, I have a principle-driven approach to investing, which has helped me think about things. I read it every single day, whether it's stocks, real estate, I think about these things. There are 5 tenets. 1, we are investors, not speculators. 2, every investment is the present value of all its future cash flows. 3, we don't understand it, we do not invest in it. 4, in the short run, stocks are a voting machine. In the long run, they're a weighing machine. And the fifth and most important one, a great story becomes a bad investment if you pay the wrong price. Guys, if you want those tenants sent to you and explained, click the link below, enter your email. We will send you our PDF absolutely free. Keep it handy for you. That way, when things are volatile, you actually should do it even when things aren't volatile. Pull it out, read it, embrace it. So guys, I recently recorded a video on the #1 stock I would buy in 2026 if I had to just choose one right now based on my valuation. So click the video on your screen right now. Thank you for your time.